The Australian RBA cash rate is currently at 1.5%. It's been steady there for almost 2 years now. So we've had a higher yield than elsewhere around the world, for instance the US, which had emergency low cash rates. They've been increasing their cash rate over recent years to largely negate that differential. Going out the yield curve spectrum, our 3s and 10s are 2.25% and almost 3% in the 10 years. Volatility, this is at the higher end of the range, and we've had a range of 50 basis points in the 3s, and the range in the 10s has been between 2 and 3%. One trend we've noticed is a bit of divergence between the Australian yield curve and the American yield curve and the US Treasuries. As the US cash rates increase and the yields have increased, our yield curve hasn't sold off as much as the US, so we've outperformed, and currently our yields at the long end are less than the US Treasury yields. And this is the first time this has happened in over 2 decades. So one dynamic in cash and fixed interest rates over recent months has been elevated bank funding costs at the short end of the curve. This has been a global trend caused by the US Fed's ceasing quantitative easing and the US Treasury continuing needing to fund their budget deficit. This has pushed bank short-term funding spreads wider and meant better returns for investors. So one way to take advantage of this is we've just been buying short-dated paper in the Australian market at a spread which is historically cheaper than what we normally would, or a yield that's higher than we normally would buy there. So we've been aggressively buying into that in the portfolios. In 2017, credit markets had an extremely strong run. However, in the first quarter of 2018, we've seen the outlook diminish somewhat. And while there's still good gains to be made from credit, it's more important to focus on allocations within different sectors and also different parts of the curve, and being very focused on relative value for individual securities. So we think active management of credit in this environment is far more important than your allocation to credit as a sector. As our macro view on credit has weakened over the last few quarters, we've reduced exposure to credit and become slightly more defensive. In that way, we've gone shorter in credit exposures, and we've gone up the capital structure into higher rated credits. That being said, there are certain sectors, subsectors, or industry groups which exhibit more value than others. So we've reduced exposure to some and we've increased exposure to others. For instance, we still think that there's good value in corporate bonds in the credit spectrum, that being traditional industrials, telcos, infrastructure assets and the like. They're offering good returns and they have a place in the portfolio, and they continue to be there. Where we've seen some volatility and some change in outlook has been the banking financial sectors. After a very good run over the last couple of years, the outlook for the Australian banks has been gone from quite strong to more muted and slightly negative. So in the portfolios, while we still have a modest allocation to the Australian banks, it's been less so than the previous years. Coincidentally, the outlook for offshore banks has been better in terms of their relative value. They have a good pickup, and the outlook is a little bit better as well. So we've increased our exposure to offshore banks in the portfolios as well. The two key risks in fixed income markets are duration and credit. Yep. So in summary, the duration outlook, given the current cash rate and yields where they are, it's probably less expensive than it has been, and there's some value starting to appear at the short end of the yield curve. So we're positioned for that in the bond fund. In terms of credit, as a sector, we're allocating less exposure as a sector allocation to credit. We still have healthy exposures to it, but we're very focused on extracting value from subsector rotation, relative value trading and positioning across the curve. And we think that's the key to maximising risk return for client in this environment.